How's it going, everybody? Thank you for being here. My name is Antonio, and today I'm interviewing a company that's been heavily requested by the viewers and some other people out there on the internet. It's Peninsula Energy. Before I get into that, I want you to know that this company is not paying for video production or any of that. I do not send in any questions before that. But before shooting the interview. But that doesn't mean you should use this video as independent research or analysis or anything along those lines. This is simply a general and impersonal conversation that will include a lot of forward-looking statements, speculations about future events that may or may not ever take place, stuff like that. It's also going to be a conversation that will not include any financial advice whatsoever. So please proceed with caution. As always, do more research before trusting talking heads on the internet, as we always say. Most people who do that end up losing their money anyways. So unless you like losing your money, do more research. That all said, Wayne, thank you for being here today, sir.
Thank you. It's nice to meet you, Antonio.
The pleasure, of course, is all mine. I've seen a couple of your interviews, and it's sort of put it off for too long to reach out, and then I finally gathered enough information to do so. Mr. Heili or Wayne, whatever you prefer, I would say it. But before we get into the barbecue, why don't you give me like I call it some call it the elevator pitch. I call it dog walk pitch. Like if you say that we met at a dog park and you needed me to invest in Peninsula, you got like 30 seconds, maybe a minute to convince me. What would you tell me?
Look, Peninsula Energy is on the front foot right now. We have just made our final decision to restart the Lance projects in the state of Wyoming. It's a uranium production facility that's existing. And because we'll be restarting uranium production, we're really one of the first in the United States to resume production. We'll have significant uranium production in the year 2023. We funded that, and we're very excited to be getting going. So one of the great differentials between us and our peers is our state of readiness and our intention to be a uranium producer generating revenue in the very, very near term.
Wyoming projects listed on the ASX. Why?
Well, it comes from Australian entrepreneurs who put the project together. The history of this company was that back in 2007, 2008, 2009, some Australian entrepreneurs identified the project that was not being pursued by any U.S. folks at the time, and they put the project on the map. So I joined the company in 2017 after the original management team had taken the project from concept to production. So it was ASX founders, ASX developed project with Australian entrepreneurial leadership.
To more experienced or more seasoned investors, it might sound like, why are you even talking about this? This is a non-issue. Why I'm asking this is because, for example, I believe that the private placement that you just did was only available to retail investors in Australia and maybe New Zealand, if I'm not mistaken. And I mean, just generally, you can tell me more about that, by the way. But when it comes down to retail shareholders, let me go back. There was a big discount on that, right? So why I'm asking about that is because I'm assuming that a lot of retail shareholders might have wanted to participate in that if it was a TSX listed company, TSXV or something along those lines. Europeans, stuff like that. Americans might have wanted to jump aboard there with a private placement, but it was not possible. So do you maybe have plans to change the listing or bring it over to the TSXV or maybe even one of the bigger exchanges in the US, something along those lines?
Yeah, well, we've already explored North American listings. We're certainly eligible for the TSX. We don't have to look at a lesser. We're also, interested in the possibility of a U.S. listing. Look, today the project is U.S. based, and the leadership team, the CEO. I live in Wyoming. I'm U.S. based, so there's a lot of logic behind us being a North American listed company, either in Canada or the U.S. So the history aside, the history was this was an ASX company that put the project on the map. But the direction of the company certainly is to look towards a North American listing. This capital raise that you mentioned, we did focus on attracting North American institutions to the register. We put a concerted effort into that in this particular capital raise, and we were successful in doing so. It is a part of our longer term strategy to shift towards a North American listing, to have some cornerstone investors in the United States and in Canada. So a great deal of attention was put to that. Now our retail investors, our existing ones in Australia are being taken care of with the Australian vehicle, which we call a share purchase plan. We're offering up shares at the same price that we did the institutional raise on, or the placement, to our existing shareholder base of record. So they all have an opportunity to top up their shares at the discounted price.
That's why I'm thinking about this. I guess, by the way, on the same note of the capital raise, you often, I'm gonna try and tie this up in one question, but you often say that you're an undervalued company relative to your American peers, and your stock has indeed been lagging the sector, or to say your peers, but also the sector. I mean, including the ETF. If you're already that undervalued, why did you have to give such a large discount to the market price on that raise?
There's a couple of ways to look at this. Indeed, we think that the market hasn't fully appreciated Peninsula. Back in August, and this is being recorded here at the end of November. Back in August, we released our definitive feasibility study, and our definitive feasibility study showed the case of us turning production back on at Lance, and how much the capital investment would be and how much the operating costs would be. It was a good document, but in that it suggested that we would need to raise on the order of $60 million US to ramp up the project to a full 2 million pound per year rate. On the heels of that, the market appreciated that Peninsula Energy would be coming to the market and doing an equity raise. And anytime a company is situated like that, the markets don't generally push upwards. They push your share price downward. That's just a fact. And so from the period of late August until now that we've completed the equity raise, our shares have traded rather laterally. They haven't moved upward or moved around with the market and with our peers. We address that. Now we're post raise. That question's behind us, and the door's open for us to move forward. In North America, if you're raising, if you're doing a bought deal or anything in Canada, you're typically issuing shares and a warrant, of maybe a full warrant for shares or an option for shares. The Australian markets tend to appreciate share pricing, which is just a straight shares deal, and so in relationship, the discount looks a little deeper. But what you're not doing is giving away warrants and or options to the institutions. So you have to do an apples and apples comparison. The discount rate was relative to the Australian market pretty normal.
Sure. Okay. Why I brought this up? Why I'm bringing up the discount on the share, on the raise in the capital raise that you just did, while we are talking about the listing, is because I'm thinking about why you were so undervalued to begin with. I mean, why do you think you're lagging the sector? Could it be something to do with your listing? Because if you look at your neighbors, there are companies with fewer pounds in the ground and that are not at the same stage that you are, that are at around the same or even higher valuations. So why do you think that is?
Yeah, well, I agree with you that our North American peers have tended to trade at better valuations than Peninsula, and that's one of the reasons why Peninsula sees the value in seeking a North American listing. We think that can, boost our share price to have exposure to the North American markets, or better exposure to the North American market. So absolutely, that's what's interesting to us is the opportunity to move there. We've always kind of held on to the notion that we would do a North American listing after we got the project up and running. Our history as a company was that the project was put into production in 2016. Or late 2015, and that the production results of the project under the chemistry set that the company used at that time were disappointing. I came on board in 2017, and part of the path and the journey that we are on was really to be correcting the process chemistry to change from the alkaline chemistry set to a low pH chemistry set. We can talk about that eventually, but along the way, when a company underperforms on its initial production and then undergoes a transformational process, that tends to put a lot of burden on the company, and a lot of shareholders go to the wait and see kind of stance. Today, Peninsula has checked all the boxes. We've technically de-risked the low pH transition. We've completed the regulatory process to fully authorize us to use the low pH. We did the financial analysis, through the definitive feasibility study, and then we've now completed the capital raise, which will allow us to put the project back into production. So this is an exciting new time for us. This is an opportunity for us to finally realize the re-rating, to demonstrate to the world that we can produce successfully, and in today's markets be very profitable.
Okay, I do want to talk about that. Because like most projects, as you said, like most U.S. projects, your project has history. And you're mentioning the low pH acid that you're going to go ahead and try to use now, as opposed to the alkaline, I guess. Why? Like, help me understand that. Is that cheaper? Is it better for the environment, or how should I look at that? I mean, there must be a downside too. What are the risks? Sort of help me understand it.
Oh, certainly. So context first. Here in the United States, and I'm a child of the U.S. Uranium industry. I've been doing this for over 35 years. Coming straight out of college and into the U.S. uranium industry. And most of my career, I've been practicing in-situ recovery. And the in-situ recovery industry in the United States was really grown up around alkaline chemistry, which is, adding a sodium bicarbonate and oxygen. The oxygen dissolves the uranium, and the carbonate complexes it, and we're able to sweep that uranium complex through the formation and recover it in groundwater. That works pretty well, and the U.S. industry used that chemistry because most of the U.S. ore bodies that it was applied to were sandstone deposits with fairly high carbonate concentrations. High carbonate concentrations tend to exclude acid chemistry or acidic chemistry because the acid consumption goes way up with a higher carbonate. At the Peninsula project, the Lance project, we recognized first and foremost that the uranium mineralogy that we have is slightly different than the average or typical uranium mineralogy in Wyoming and in South Texas ore bodies where in-situ recovery had been practiced. We also identified that we had a lower carbonate concentration than the typical. So those two factors, technical factors, meant that the low pH or acidic chemistry could be applied. We took that to our laboratory. We tested the low pH chemistry on the uranium mineral and core samples, and we found that we had extraordinarily positive results. We could recover a higher percentage of the uranium in a shorter period of time using the acid chemistry, and that means lower costs for us. That means lower operating times and higher recovery solution grades. Following that, and over the course of the last several years, we went to continue the technical demonstration. We did that on a field level. We did field level demonstrations of the low pH chemistry, and we proved up the laboratory results and the field results. The truth is, for us, the uranium mineralogy, the host rock constituents all guide us towards low pH chemistry rather than alkaline chemistry. And we had to become the thought leaders in the United States with respect to that. We're the first and only commercial in-situ recovery operation for uranium that's licensed to use the low pH around the world. Kazakhstan, Australia, Uzbekistan, Russia, China, you name it. Every other country that's using in-situ recovery methodology is using the low pH chemistry. And that is because it's more effective, just like we see, and it is a lower cost approach to in-situ recovery.
So what are the drawbacks? I mean, you saying, has it been done before? I mean, are there assumptions that you're taking while switching the plan from alkaline to low pH? And also, you said, it's cheaper, and all that. I agree, but there must be downsides to it, or at least risks, right?
Well, for the U.S. industry, the downside was that we had higher carbonates in our ore bodies, and that meant higher acid consumptions and generally higher costs. So the U.S. industry has done the right thing over the years, don't get me wrong. The Lance project is specially situated with a lower carbonate host rock and a mineralogy that is more amenable to the acidic solutions than it is to the alkaline solutions. So we're just following the science, if you will, if I can borrow the cliche. We're following what the host rock tells us to do and what the mineral tells us to do, and that's going to lead to superior results for us.
Okay. What then? I guess the costs are the big one here, right? Especially in this rising cost environment. And I guess we can jump right into this, right? Your new DFS from this summer showed roughly $46 in all-in cost. So that's the number next to, you share that number next to that all-in sustaining cost. So those are two different numbers there. What is that? Does that include your I know normally the all-in sustaining cost wouldn't include like G&A, marketing and financial expenses. What does that cost include for you?
Yeah, so it's much different. The all-in cost is the cradle to grave cost. Okay, I mean it for the project, it's the capital to get up and going, and it's the reclamation costs and the life of project costs. So $46 was our all-in cost, cradle to grave. It included, like you said, G&A and everything. All-in sustaining costs is a slightly different measure. When you're up and producing, the way we've approached this is what is our cost on an ongoing basis when we're continuously producing at a steady rate. And that steady rate in our definitive feasibility study was close to 2 million pounds per year. So when the project is up and running and sustaining a 2 million pound per year rate, what is your all-in costs, if you will, or your all-in sustaining costs? So the $39 figure is really what it was. We actually have very low direct operating costs. They're in the teens. But to sustain an operation and keep it running at a continuous rate, you have to invest capital into new well fields. And so the difference between our direct operating costs and our all-in sustaining costs is the capital that we're continuously putting into the project to keep it running at a higher rate.
If we add all the other things that I said, though, the G&A and financial expenses and other stuff like that, would it be fair to say that at $50 uranium today, it's not really worth going into production for you right now?
Well, it is. Look, the market's moving upwards, and the global picture for supply and demand for uranium is that there's a significant supply shortage. So today's $50 probably wouldn't prompt us to move into production with an all-in sustaining cost around 39 or an all-in cost around 46. But yeah, because who wants the profit margin of that, right? But Peninsula has contracts. We have long-standing contracts with customers in both the United States and Europe, and those contracts signed back in the mid-teens, 20 teens, 15, 16, when the project was being put into production initially. They had been maintained, and the price structure of those contracts is better than today's market, and offers more incentive for us to go back into production. So, we're looking at a contract book that has an average delivery price of about $60 a pound. And, it's going to be more economic for us to produce those pounds than to try and fill them out of the market. And in some cases, quite frankly, Antonio, our contract book calls for production rather than market sourced material.
Can you tell me a little bit more about those contracts? Because I know a little bit about them. I think they're right under $60. You did your DFS at 62, though, and those contracts run as long as 2030, so at the end of this decade. So, what can you tell me more about those? Are you still remaining or keeping positive exposure to the potential run up in the spot price, or how do I look at the existing contracts today?
Well, sure. I think you got to look at the existing contracts as a baseline sales for the company of between 400,000 and 600,000 pounds per year, which means that when we ramp up production in the first stage, which is what we've just committed to and expect to be producing early in 23, that half, 1/3 to half of our annual production is available for the markets. So the balance is going into those contracts. Now those contracts are profitable, and if the markets continue to move upwards, the balance of the production is available for the markets and can be even more profitable. Yes, our definitive feasibility study, it takes into account our contract book, and it took into account a firm called TradeTex, which is an industry professional firm, their price projection for the forward curve for uranium. So the forward curve for uranium suggested that the future price average that we'd sell our excess production into the markets at was $65. And the average price then, the combination of our sales portfolio and the forward solds or the available excess inventory got to us to a $62 a pound average sales price in the DFS. Now, if you make a different assumption than $65, and a lot of people would be inclined to do that, myself included, but I wanted to use somebody else's curve, not my own opinion. I think that's the right approach. If you say another $10 a pound on those, then we see, significantly higher net present values of the project. We add probably $60 to $70 million of net present value into the project just by making a higher price assumption for sales of uncommitted pounds.
The cost, though, at which you're producing, I guess we might also want to focus on that, the 40, 46 something. I guess if you add G&A and all that other stuff to it, it's probably above 50. But is that's assuming the low pH?
No, it's 46. We can't just assume 50, and all-in cost is all-in cost.
I mean, if you add the G&A and financial expenses and other stuff, that's just your all-in cost. That's right. Absolutely everything.
Corporate costs, etc. Yeah. Okay. If all of the project or the companies supported just by this project, there's a little more. Sure. Go ahead.
Yeah. Okay. Yes, I mean, is that fair? Do you think that's fair? I mean, I don't know if that's is that a fair assumption? Is that a fair thing to do to count all the other expenses into the cost of production? I don't know if that's fair. What do you think?
Look, yeah, but I think you're probably up at a higher number than it needs to be. Our corporate overhead is very low. We spend about $2 million a year on corporate costs. So if we're producing 2 million pounds a year and we're spending 2 million on corporate costs, guess what? That's about $1 more, not 4 or 5.
Okay. No, fair point. Fair point. That's what's important to talk about these things. But that cost, though, your production cost, is assuming that the low pH solution yields good recoveries, right? But I guess better recoveries than what you saw in 2018. How certain are you that it will yield above the? I read somewhere, you can tell me if that's right or wrong. I read that the average for alkaline leach was around 60 to 70% recoveries. You're talking about almost 66% recovery in your DFS. How certain are you that you can keep that on throughout the life of mine, which is what, 14 years?
Well, that really was the purpose of the last several years. We were technically de-risking the project. We did side to side or back to back or side by side leach tests, laboratory tests with alkaline chemistry as opposed to the low pH chemistry. The low pH chemistry far exceeded the capabilities of the alkaline chemistry. Like you said, we could get about 60% recovery with alkaline chemistry. We could get about 100% recovery. Virtually all of the uranium mineral came out with the low pH chemistry. So in the laboratory, we know already we've established the baseline expectation that the low pH chemistry is far better than the alkaline chemistry on our ore body. We took that then to the field. We did 2 different field demonstrations. We did one test called the field leach trial. And in the field leach trial, we actually acidified commercial patterns that were operated in alkaline chemistry. They were operated as alkaline chemistry patterns, and they were operated until they were fully depleted by the alkaline chemistry means. We acidified them and we operated them as low pH patterns, and the low pH patterns yielded significantly more uranium at good grades, uranium that we could not get with the alkaline chemistry. The second field demonstration that we did was on a fresh pattern, an area that had never been operated. And we, from that area, we recovered 90% of the uranium in that field demonstration. And that was field scale, full scale field operations. So our confidence level moving it back into production is very high.
Okay, fair point. I'm sorry for concentrating on costs here, but what I've seen in the recent past since I joined the natural resource space is that when companies get into production, what often challenges them is economics. That's what it comes down to, I guess. And have you? I assume you have, so maybe I should ask how much. But for example, when I spoke to Kazatomprom, I interviewed Kazatomprom, and they told me that their ISR expenses have gone up 30 to 40% on occasion. They're even struggling to find. They wrote that in one of their reports. They're struggling to find pipes and acid, even at the inflated price levels right now. And they're even coming short in terms of production too. I mean, they were buying in the spot market last quarter and stuff like that, meaning much more expensive pounds than what they would normally produce if they were doing it themselves normally. So what about your numbers? Is inflation and the supply chain shortages and all that? I get you did the DFS in the summer, so I guess you took that into account, right?
Oh, absolutely. We were very systematic in our approaches. We got the regulatory approvals. We did the technical de-risking, and the last step for us before we made this final decision to move back into production was to complete an up-to-date and current financial analysis. That's what we released in August. And absolutely, in 2018, we did a feasibility study on the low pH, and we assumed things like acid costs to be about $160 a ton delivered. And the 2018 prices, that made a lot of sense. That was going to be our cost for sulfuric acid. Well, guess what? In 2022, the price of sulfuric acid has been through the roof. It was double that. So we used a sulfuric acid price assumption that was $320 a ton instead of $160. The project still withstood all of the inflation, all of the supply chain issues that the United States and other nations, as you pointed out, were enduring during 2022. The feasibility study was wide open with our eyes towards what the current market was, and that actually presents for us a lot of opportunities on the upside to outperform the feasibility study, to to have prices that are lower than the all-in sustaining costs of $39. Because guess what? Today, the price of sulfuric acid is moving downward, and it's moving downward fast. It's moving back closer to its historic levels, and availability is going to be there. Yes, in 2022, pipes, plastic pipes, fittings, everything, valves, all the things that we want and use on a regular basis have been challenging to secure, and that's really residual effects of the pandemic. I have to believe that the world is going to get over that, and that we're going to get back to a more normal economy with more normal supply chains, and that this project in the future can outperform the analysis that we did in the middle of 2022.
I'm happy you're bringing this up because I wrote upside, and I wanted to talk about that because if we assume your DFS net present value of $125 million there, your market cap after the recent raise is some, not $90 to $100 million, we can call, and probably closer to 90 right now. If the price runs up 25-30%, you're basically at one time MPV. What is the upside there for you to generate more value than what is represented by that DFS?
Well, it's not just the operating costs and the capital cost forecasts that have been done on a pretty conservative basis at a challenging economic time. The upside for us at Lance is really the resource. Look, in a change of manner that from what we previously had done, the 2022 definitive feasibility study only included a portion of the Lance projects. The Lance projects as a whole are three different projects. There's the Ross, the Kendrick, and the Barber projects. And the Ross and Kendrick area is the area that we included in the feasibility study. It's about a third of the overall size of acreage of the Lance projects, just 1/3 for Ross and Kendrick. It's not 1/3 each, it's 1/3 total. And Barber, the third project, is got the other 2/3 of the acreage. But look, in the Ross and Kendrick area is the area where we've done more extensive delineation drilling on the resources, and we've upgraded the resources to be measured and indicated categories rather than inferred. The Ross and Kendrick resources constitute about 22 million pounds of total resources, and the DFS just assumed a production of about 14 million pounds of uranium from those. The Barber area contains over 30 million pounds of additional resource, and it was not included in the DFS. So the upside for us in the future is to upgrade the resources at Barber from their inferred category, because this was an area which was under delineated and under appreciated on the resource. We have the opportunity to upgrade those resources to become measured and indicated and wrap them into our project economics. And we also have the opportunity to upgrade those resources. Our experience in the Ross and Kendrick area over the years was when we converted inferred resources to measured and indicated, they tended to multiply by a factor of 2 to 3 times. So the 30 million pounds, this is very forward looking, and this is a statement of resource or exploration potential. But the opportunity for us is that the 30 million pounds that exist at Barber could go to 100 million pounds. Okay. And none of that is included in the DFS, the NPV, or any of the financial figures that you're comparing our market cap to. So if you look at the DFS, that's not everything that the company owns. It doesn't include our uranium inventory. It doesn't include a lot of things. It's just not even a fair comparison to say your net present value is 125 in the DFS and your market cap's 125. What's the upside? There's
Hmm.
so much more to this company.
I like that answer and that explanation there, because it is absolutely something that someone with as shallow of a depth of field as mine would do. So it's a good explanation. Why haven't you done that? I mean, if you're talking about £100 million, would it take too long for you to bring it into a DFS? Is it expensive to do it? Why haven't you done that?
Yeah, it requires an investment in exploration and delineation drilling over a large period of time. The intention with the project at Lance was always that, look, we have 53 million pounds or 54 million pounds of JORC compliant resource. It's a very large scale project. We have a project that's licensed to produce up to 3 million pounds a year. You have 50 million pounds of resource. That's a long life project already. You can spend a lot more money delineating and developing additional resources, or you can put the project into production and you can fund that exploration drilling out of revenues from production sales. So, I mean, up front, you're going to have to turn to investors and shareholders to fund it. Or you can fund it through ongoing cash flows generated from production. So the company's intention was, with the largest U.S. Uranium project licensed and ready to go, there was no need to expand the resources. But at the same time, when 30 million pounds of resources is sitting there in an inferred category, and you can't really do your project economics on inferred resources, there's plenty of incentive to get going and start expanding that resource.
How much would that cost? Like, again, very forward-looking statement and stuff like that. How much would that cost, and when do you think you're going to start working on it?
Well, the company has recognized the value of doing that, and we're looking to start committing funds, a couple $1 million a year, to the delineation of the Barber resource and the definition of the Barber resource. And probably starting in 2023, maybe 2023, but probably 2024, we're going to do some drilling in the Kendrick area first, which is going to bring the inferred resources of Kendrick up to a higher definition. Look, over the life of the project, the additional drilling to upgrade the resources in Barber from inferred to measured and indicated is probably an investment of about $50 million, and it should be done over a 5 to 10 year period.
5 to 10 year period. Okay. Wow. Before that, I guess you're gonna have to restart and see if you can get this thing cash flowing. I guess that would help.
Well, and that's it. The whole point is to pay for it out of cash flow rather than upfront with an equity raised dilutive funding.
So what if in a perfect world you will not have to raise any capital anymore from here on? Because I guess the money that you raised, what did you do? $32 million, if I recall correctly.
Yeah, it was 32 million Australian, which translates to about 21 million US.
Is that going to be enough? Like, are you going to have to raise money next year or something along those lines again?
Look, it's enough to get the project transformed to the low pH chemistry and to get the project up and running. We've guided that the money that we'll have on hand after post the raise and the uranium inventory that we have, is enough to get us into 2024. If we want to expand the project from its current capacity up to 2 million pounds a year, or in the future up to 3 million pounds per year production rates, then we need to invest more capital. And but the nice thing is, once you're up and running and you're a producer, you're financeable and you can use debt financing mechanisms, things that really aren't available to you when you're not currently a producer. Debt financing, convertible debt, those sorts of things are very expensive and burdensome when you're not a producer. But once you're up and running and a producer, you have a lot more finance options available to you. So, getting up and running first, very important. deciding on how we'll finance and pay for future expansions, to be determined later.
Good answer. If I'm sorry if I'm being silly here, sticking to it, but if I recall correctly, you called it this. I mean, you call it, and rightfully so. This is not like you're not starting new production; you're restarting your mine. So the upfront capex is not a lot, but it's still in the tens of millions multiples. So what is that money being spent on? And is that not a lot?
Well, actually, so the feasibility study defined the stage one capital and the transformation, the project transformation capital combined at about $25 million. Now, with this capital raise, we have that capability. So we can get our project up running into stage one. The money goes into converting the plant so that it's capable of running with a low pH rather than with an alkaline chemistry. You know, the pH means that we have to use some different coatings internally and different materials of construction. So we change that out. We also have to add something that we didn't have, which is a full-scale acid storage and distribution system, because the alkaline chemistry didn't have that. We have to get the ability to move a lot of acid through our system. But the conversion costs, the transformation of the project was estimated and re-estimated again in the middle of this year under $6 million. That's pretty small. The additional capital that we need is sustaining capital. It is to build new well fields and allow us to continue producing and ramp up our production rate. So money goes into the area we'll call well field 3 or mine unit 3. That's probably closer to $15 million.
Okay, sure. Aside from the cost and the just general work that you're doing to restart that, what else do you have to do between now and getting into production? And well, let me maybe tell you why I'm asking that, because while you're at it, maybe you can answer that too. It might be worth talking about what you think the risks are for doing this, for achieving what you're hoping. Like, well, what keeps you awake at night?
Well, fortunately for us, we've been on this path towards the resumption of production, for a long time. We've anticipated that by the end of 2022, we would make this decision. So this isn't like something we just woke up to and said we got to do it. All of 2022 has really been spent preparing the project for a resumption of production. Our team, which is, we're fully staffed for that. We have the operators, we have the technical team. We've never let them go. Our team is very experienced, and because I have a very experienced team ready for operations, I don't lose as much sleep as another CEO might, because I know that the people at the site are very capable of doing their job and doing it well. So, getting them the funding and getting them the instructions to move ahead, I have a lot of confidence in the team that we have in place. We have been spending money preparing the project throughout the course of 2022. We started developing that third mine unit, and mine unit 3. We've been drilling out there all year long, getting it ready. We know the resources are good. We're starting to put in the monitor well ring and getting it ready so that it can come online late in 2023, hopefully. A lot of things in place. We've been tracking the supplies that we need, the materials that we need. There are still some things that, the things that'll make me nervous. We have a line on a tank. They said it'll be delivered in February. What if it's not? And a lot of those things these days are still uncertain. Delivery supply chain is still difficult, but we've kept a very close finger on the pulse of acid and the core supplies that we need and we're actually very ready for the resumption of production.
This might be, and I've mentioned this before, when Kazatomprom announced that they're having issues and they're having to go to the spot market to find some of the pounds to, um, sell into their contracts, actually fulfill their contracts that they had before that. This is actually a point for many people who have a bear case for uranium, saying, oh, the price of uranium hit $75, all this new production is going to come online. While in reality, if there's so much demand for uranium production, meaning if there's so many companies who want to get into production at the same time, they might experience shortages of materials like pipes and all the other valves and whatever you mentioned there. So I think that's a wake up call from an actual industry insider like yourself. Is that,
Yeah.
are
Well,
we
and
experiencing that in other fields too?
yeah, Antonio, it's not just materials and supplies, it's people. And that's one of the things that sets Peninsula apart is we do have the team in place. We have the people. The U.S. uranium industry has been in retraction for a decade. Guys like me who've been in it for 35 years are few and far between. I cut my teeth in this industry. I've been producing, and growing in the U.S. uranium industry throughout my career. But I came in at a time that the uranium markets were weak, and we saw contraction. I just had the exception that that I had opportunities in my career, and I stuck with uranium throughout. But the people, it's going to be really hard to staff up multiple uranium production operations in the U.S. Because you're going to be using people who don't have the experience. The Peninsula team has over 200 years of direct uranium production experience. It's a comprehensively solid team.
Why isn't the U.S. uranium industry then consolidating more and doing more M&A? Because that's one of the Rick Rule calls it one of the one of the diseases, I guess, of the natural resource sector or something along those lines, saying that there's just too many teams running not a lot of pounds. Like there should be, he says, it should be like 5-1 consolidation or something along those lines. Why isn't that? And maybe have you been approached by any companies? I know there's a few around you that might be interested in your assets, but yeah, talk to me around that. I don't know if I have a question, but it's an interesting
Yeah,
topic.
well, there's probably in the United States today a handful of companies that have licensed projects that are looked at as production ready or near term production ready. Of those companies, credibly, who has the production team? There's probably only 2 or 3 of the handful. So, let's just lay it out like that in an M&A context. Somebody who has projects that are licensed and ready but don't have people are going to need the people. you know, Companies that have the peoples and the projects are really sitting in the driver's seat for valuation and opportunities here in the future. I believe that Peninsula is completely underappreciated for that facet. That we've kept our project waking up to the news release that we're starting our project and see that coming. Everybody else is making final investment decisions and they're saying, well, we'll be producing in 18 months or 2 years. And we made our final investment decision and we said we'll be up and running in a matter of weeks. How is that? It's because of the hard work investment we've made in the people and in the project.
So again, to go back to sort of your neighbors and the companies that have been approaching you, is there something you can share with me there? And is there talks? I mean, you're pretty close to each other with a couple of companies there, so I guess you do talk, I'm assuming.
Oh, sure. I think that one of the beauties of the U.S. Uranium industry is the closeness of all of the people in the industry. We're surviving together. we've survived this market downturn together. We work together in the Uranium Producers of America to advocate for our interests. I have personal friendships with a lot of my industry peers. Where that leads to in the future with respect to M&A, who's to say? But we all have our own projects. Probably one of the things that holds back M&A is that most companies are perceived to be project rich. We have a lot more licenses and production capacity that's being underutilized than we should. Our projects should be running, and when you have everybody living up to their full potential, that's the fun time to do M&A. Right now, Peninsula is the first U.S. uranium project to return to production and commit to returning to production. So we're going to try and live up to our potential. We're going to show the world what that potential is. A lot of the other companies are talking about returning to production, but haven't made that commitment. We'll see how that goes. But problem with M&A is that the space isn't living up to its potential today.
That's what I was thinking about as well, that some of these companies also value them differently in terms of they would value themselves using EV to pounds in the ground ratio for some reason that escapes me. And I've spoken to one of your industry peers, Jeff Glenda. I mean, he's now retired. I've also spoken to his new CEO, John Cash. Both of them don't like the EV to pounds in the ground ratio. What do you think about that ratio? Is that a fair way to value a company, a uranium company?
A production company, no. A development or an exploration company, yes. How else are you going to value an exploration company? You got to value their asset, which is pounds in the ground. A production company needs to be valued for its team, for its production capabilities, its license, its hard assets, which are the plant facilities that we've invested into. It's really about capability when you're a producer. So exploration companies, there's really no choice but to value yourselves on a pounds in the ground basis. But Peninsula, really should live up to much better valuations based on both its resources, its pounds in the ground, which if you use that metric, EV to pounds in the ground, we're definitely undervalued, and we also don't get full valuation for what we're about to show the world, which is our production credentials.
There's I spoke to somebody else who had a different opinion as well, saying that you could use the EV to pounds in the ground ratio as long as you discount it for the probability of those pounds ever leaving the ground profitably, which is not the case with many of these companies. And then you would discount them by pretty much 100% because they're not leaving the ground profitably during this cycle. Probably reasonable probability is what they talk about.
Yeah, I think that's fair, Antonio, except the challenge for investors is to know to differentiate, to know which ones are good, which ones are bad. There's always going to be somebody who's a successful promoter of a bad project, and there's going to be somebody who's a credible a producer or promoter of a credible project. It's hard to differentiate pounds in the ground if you're an investor. You have the JORC or the 43101 or the SK 1300 systems, which are supposed to equalize things, and they do a pretty good job of that. But the uranium mineral type and the producibility of a resource, the depth, the other factors, there are a lot of pounds in the ground that aren't going to get produced, and they should be factored lower than the pounds that are on licensed and producible projects.
Yeah, absolutely. I mean, once you start getting into it, you really realize that it's a lot more complicated than just looking at the JORC or the NI 43-101 resources, because all you got to do is like pick up a book or even a video or a blog post on metallurgy, and then you start realizing that you really know nothing. Especially, yeah, I mean, when it comes down to uranium, if it's not in the Athabasca Basin, metallurgy can get quite complicated. Back to Peninsula though here, Wayne. You say that you're an undervalued company. You got to make the market, you got to help the market realize that. And I see that you're doing some promotional activities, some marketing activities. I don't know if it's fair to call it marketing because you're not selling anything really, but promotional activities. I believe you did an interview with proactive investors, and you also I assume you're paying for Crux in terms of retail shareholder awareness information campaigns, if you want to call them. But what else? What are you going to do to tell the story, help people realize that what you think, that there's value there?
Well, with this production decision, we have a lot, of news to share. We've been a nose to the ground, get it done company with respect to the de-risking work and efforts that we've, foundational work that we needed to do before getting to this point. So we'll be out speaking a lot more, taking the opportunity to do a lot more non-deal roadshows, going out and talking to investors, institutions, and focusing, continuing to focus on North America like we did in this last capital raise. Get North American shareholder base up for this North American oriented project. So it's just an incumbent on us to continue to spread the word. But today, we think that we have a great story to tell and a great future ahead of us. So, the foundational work and the de-risking work is really behind us now, and it's up to us to perform as a producer. And I think that the markets are going to take a lot more notice of us for where we are and where we've come from, and what we're doing, moving forward. So we'll spend more time on investor relations and put more effort into it, because the technical work, the de-risking work, is now pretty much in the rearview mirror.
Are you going to start focusing more on retail shareholders specifically then? Because I know that you spoke in your last capital raise. Feel free to tell me who you were talking about if you're at liberty to do so. You're talking about some big institutions coming on board, and a couple of times throughout this interview you mentioned institutional ownership and stuff like that. Are you going to spend more time focusing on retail investors now?
Well, reaching out to retail investors is platforms like your own. I think that a lot of people, social media is a way, but it's difficult. Candidly, it's very difficult for a CEO or a person like me to do too much on social media. We have the obligation to make sure that all of our disclosures, all of our discussions are publicly available, and that everybody has equal access to those conversations. So I can't just Twitter post as much as perhaps people would like me to, that Peninsula is doing this or Peninsula is doing that. It's just not the proper way to disclose information. So all of our material disclosures go through press releases, and retail investors and our 12,000 or thereabouts shareholders all have access. They're on the mailing list. We get our disclosures out, that and our releases out to our shareholders. But we'll continue to speak at conferences, be publicly involved, and take up opportunities like this to speak with folks like you.
Yeah, I like that. I guess there's no real risk for you here because these are free, and I'm generally okay with that as long as they don't cost too much money. Though I'm not sure that platforms like mine are the best ones to market, maybe to inform, not necessarily to market. And I think that the industry, it's just a personal opinion, and I'm not sure if it's right or wrong, but I think the industry might want to venture more towards informing the existing and potential shareholders, as opposed to pushing stock down their throat by going on a show, or having someone else review your company and say this is the best company I've ever seen, and you pay them 2, 3, 4, 5, whatever thousand, I don't know how many thousands people charge for these things.
Antonio, that's really never been our thing, to pay for analyst coverage. We do have analyst coverage with a number of good brokerage firms, the ones that recognize the quality of the Peninsula story. That's a good way to reach out to broader high net worth and retail investors. I think the proactive platform, which you spoke about, is also one of our tools in our chest that reaches broader audiences. A lot of people, retail investors in Australia, have quick and easy access to the proactive interviews and stories that are crafted there. And just like this, when I go on talking to the folks at Proactive, it's not scripted. It's they looked at our story, then they ask a couple of unscripted questions, and we share the highlights of what's going on. But it's not hey, you need to ask me this so that I can tell you that. That's never been the case with Proactive or anybody else that I talk to.
Yeah, well, it happens a lot, and I hear that
it does.
It's getting more and more expensive, though in my opinion it's working less and less because people are waking up to that kind of behavior.
Yeah, we don't spend our money that way. It's just not where our budget is focused.
Well, keep at it. Wayne, I think I'm all out of questions here. Is there something that you came here hoping to talk about but I failed to bring up?
Really, no. Thanks for asking that. Look, I think we've got the clear message across. The Peninsula is on the rise. We've done the hard foundational work to put our project back into production, and now we've taken the decision to do that. I think it's going to be an exciting opportunity for shareholders. I think this is the point where our share price is really got an opportunity to move with the performance of the company and with the sector as the uranium market develops. I think 2024 is going to be an exceptionally good year for uranium producers, and I think that was not incidentally stated. It's for producers. The uranium markets for producers are going to be very exciting.
Thank you for investing in time with me, sir.
Thank you, Antonio.